Okay. All right. We are recording now. So thank you guys for coming out today. This is the Investing 101 class. So this is for anybody who wants to get into investing, wants to learn about investing. Maybe you want to brush up on your skills in investing. So hopefully you get a lot out of today. We have a lot of stuff to cover. We're going to try to get the class done in about an hour or so. So let's jump right in. So if you want to download the presentation after the fact, you can go to phillyliving.com/investing101. I'm also recording this presentation. I am going to make it available after the fact as well for anybody who is in the class here and anybody who can't stay for the whole thing. So I just want to give you a little bit about me to start. I have sold over 3,000 properties since 2008. Over 500 investment properties I've sold since 2008 and made my clients over $100 million in profits over the course of that. And that's really going to be the key to what we're talking about today. So whether you are here as an investor for yourself, to build wealth for yourself, or just to get more knowledgeable so you can sell investment properties to your clients, either way. So when I talk today, I'm going to be talking to you in both of those forms, one as an investor yourself, and two as a real estate agent who is trying to help their clients invest. And I've been investing myself since 2003 as well. All right, let's see how I click through these without, there we go. All right, so the agenda for today, first thing we're going to talk about is wealth building. What is wealth building? Then we're going to get into investment strategy. Then we're going to dive into different types of real estate investments. Then we'll jump into how to determine what a good investment is. And then the goals for this class is by the time we're finished, you guys will be skilled investors. All right. And if you have any questions as we go, you can pop those in the chat box. I am going to try to figure out how I'm going to look at the chat box, but if I don't, I'm going to try to look and do both. But if I don't get to your question right away, I will get to it at the end or during it. But if you have questions, just pop them in the chat box. All right. All right. So first thing, what is wealth building? So we hear that term thrown around a lot about wealth. So what is wealth building? My definition of wealth is when you have $1 more of passive income than you have in personal expenses. So what is passive income? Passive income is making money while you sleep. So with passive income, you're not working for money anymore. Your money's working for you. And the ultimate goal is to have your money work for you so you can be making money in your sleep. Another thing we talk about when we talk about wealth building is the wealth ratio. So you hear a lot of terms thrown around with net worth and wealth. The one that I look at is the wealth ratio. And the wealth ratio is you take your passive income that you get in the course of a year or a course of a month, and you divide it by your expenses. So for example, if you have $100,000 of expenses to live your life, and you have $10,000 a year in passive income, then your wealth ratio is 10%, right? And the goal is to be in the 100% club. The goal is to have 100% of your expenses covered by your passive income. Because theoretically, when we talk about retirement, and we're going to get into this later in the presentation, when we talk about retirement and when people talk about being rich and retiring, the reality is you don't need to have any money in the bank to retire. If you have enough passive income to cover your expenses, you don't need to tap into your bank account and to the money in your bank because you're going to have enough coming in passive income. That's going to be the ultimate goal of what we talk about today. All right. So I'm going to give you guys some stats about wealth building that are pretty interesting. And I'm not sure exactly where these came from, but these are pretty interesting statistics. So the typical age that we talk about in America for retirement is about 65 years old, right? When we're growing up, when we're kids, we talk about, retiring by the time we're 65, or that's what people talk about in general. But the challenge is that most people haven't planned properly to be able to retire by the time they're 65, right? Because you don't know how long you're going to live after 65, and you don't know how much money you're going to need to spend during those years after you're 65. And a lot of people don't do what's necessary. Even if they did know those numbers, they don't do what's necessary to prepare for that time in their life to have enough money in the bank or have enough passive income coming in so they can retire by the time they're 65 or whatever the age is. And it's because people don't have long-term perspective. So here's some statistics. By the age of 65, so these are the stats for people by the time they were 65, 36% of the people never make it to their 65th birthday, right? They've died before they're 65. 36% of people die before they're 65 years old. 54% of the people are living, but they're on family support or government support by the time they're 65. So those people can't retire. 5% of people were working because they had to work, right? They didn't save enough money. They didn't plan properly. So they still have to work. 5% of people still have to work by the time they're 65. 4% of people were considered well off, and 1% of people by the time they're 65 are considered wealthy. So that's a total of only 5% of the people by the time they get to 65 years old that are considered either well off or wealthy. But as I mentioned before, it is possible to retire with minimal money in the bank. Okay, I see some comments coming in the chat box, but we're going to get to those later. All right, so let's talk about investment strategy. So if you're under the age of 65, it's not too late to plan for this. Okay. And even if you're 65, you certainly can as well. But no matter how old you are, whether you're 20 years old or whether you're in your 50s or even your 60s, it's not too late to start planning your investment strategy. So what's the first step? The first step is number one, identifying how much money you want to make. Okay. So what that might look like is you might say, I would like to make $100,000. In passive income. Remember, we're talking about passive income, investment income. Number two, how long do you have to make it? Number three, what is your exit strategy? Number four, how old do you want to be when you exit? 5, how much money will you have in the bank when you stop working? Number 6, how much passive income do you want when your working days are over? And number 7, what is your plan? So these 7 questions should be the driving questions for how you put together your investment strategy. So whether you don't have to do it right this second, but after this call, if you don't already have an investment strategy, I want you to go home. I want you to take some time and I want you to put together your investment strategy. Okay. So what something like this might look like is, to answer these questions, I would like to make $100,000 in 10 years, because in 10 years, my kids will all be in college and I want to have $100,000 of passive income coming in 10 years. Okay. By the time I'm X number of years old. So what you'd have to do is put together that plan to every year be chipping away at that $100,000 goal, right? So that might be $10,000 a year of additional passive income. That might start out as $5,000 a year and then growing as you start to get more money and more skill. You know, starting an investment requires money and knowledge, okay, and a little bit of willingness to take risk. But just because there's risk doesn't mean it has to be risky, right? So having the knowledge to understand what investment is all about is very important. And either having money to invest or knowing somebody that has money that you can partner with, that's also going to be important. But the key is to have a long-term perspective on everything that we do, because this plan that we're putting together is not a get-rich-quick scheme. It's not something that's going to happen overnight. It's going to take 5, 10, 20 years or a lifetime to get to the level you want to get to. And the ultimate goal for wealth is to have $1 more of passive income than you have in personal expenses. Okay. So here's some different types of real estate investments. And I know that there's probably more than this, but here's the 5 main types of real estate investments. Number 1, multifamily. Multifamily is multiple units, multiple residential units contained in one property. Could be as little as 2 units, which is a duplex, 3 units, a triplex, 4 units is a quadplex. And then really, I think the term over that is just multifamily, but multifamily is strictly residential, multiple residential units. Second one is mixed use. Mixed use is a mixture typically of residential and commercial. So that can be a store on the first floor, a restaurant on the first floor with apartments above. That would be mixed use. Single family, of course, that's just a single family home with one residential, person or family living in it. A condo is a unit inside of another building. There's risk with condos because the expenses on condos are typically higher. You have condo fees, but there's benefits to condos as well because typically, a lot of times there's more amenities in a condo building, less maintenance, and sometimes people want that. But I just caution you about building your entire wealth building investment strategies around condos, just because it can become expensive for expenses. And the last one that I'm going to talk about is development. Development is, buying a property, buying a piece of land, building a new construction property on it, and you could sell it, right? You can hold on to it, but typically, in this example, you're selling it. So they're the 5 main ones that we talk about. All right. There's 6 ways to analyze a deal. And this is where we get into I don't want to say the boring stuff, but like the definitions and the really deep understanding of the knowledge portion of investing. So there's 6 different ways we analyze deals, right? And you'll hear your clients or you hear yourself talking about these different things. And it's good for you to understand these terms so you can be knowledgeable about this. And no matter what investor you're talking to or what bank you're talking to, you can really understand how to do this. So we're going to talk about net operating income, or NOI is the slang term for the abbreviation. We're going to talk about expenses. We're going to talk about vacancy rate, debt coverage ratio, cash on cash return, and then cap rate analysis is the main way that we're going to analyze properties. All right, so net operating income. What is net operating income, or NOI? So the net operating income, the way you calculate that is you take your annual operating income. So annual operating income would be the total monthly income that you get from rental property, from rental income or parking income, or like they're probably the two main ones. But annual operating income is the monthly multiplied by 12. Okay, annual operating income after annual operating expenses are deducted, but before income taxes and interest are deducted. So again, that's the definition for net operating income. Net operating income, you take your total annual operating income and you subtract out your expenses. Okay. And then you also subtract out your vacancy. So you subtract out the vacancy amount and the operating expenses from the gross income. So the formula there is at the bottom. NOI equals gross annual income minus expenses. And we're going to go over what vacancy is in 1 second. But vacancy is the percentage of the time that your building is vacant. So we're going to go over that in a second. Okay. All right, expenses. So what are some typical expenses in a property? So when we talk about operating expenses, those are the costs that are associated with the operation and maintenance of an income producing property. Okay, so these are only expenses that the landlord would have. Okay, it wouldn't be anything other than what the landlord would have. Okay, I'm trying to let some people into this meeting here. Okay. My apologies. Okay. All right. So some types of expenses that you would have for a property would be taxes. It would be management. If you're hiring a management company, you'd have to pay a management fee. It would be property insurance. It would be any improvements, trash, if you're paying for trash, maintenance, fire alarm, and any utilities, electric, water, sewer, and gas, any utilities that you as the landlord are paying. So if your tenants are paying for those utilities, then you would not include those as expenses. These are only operating expenses that you as the landlord are going to be paying. Okay, so vacancy rate. So you saw vacancy rate in the net operating income formula, but the vacancy rate is the number of months a unit is vacant divided by the total number of unit months available. Now, remember that term unit months, because I'm going to explain what that means in a second. So the opposite of vacancy rate would be occupancy rate. So the occupancy rate would be the percentage of time that the building is occupied, right? So assume you're looking at a 4-unit apartment building. So there's 4 units that are available for rent each month. So the way you calculate that over the course of a year, you have 4 units multiplied by 12 months a year. So you have 48 unit months available. So again, there's 4 units available each month over a 12-month period. So there's 48 unit months available. Okay, so assume that you had 3 units that were vacant for 1 month each. So the way to calculate the vacancy in that example is you take the 3 unit months that were vacant, so 3 units vacant for 1 month, 3 vacant months divided by 48 total unit months in the year. So 3 divided by 48 is 6.25%. So your vacancy rate in this example would be 6.25%. So typically when I'm calculating this stuff, if I'm looking at it for myself, I might be a little more conservative and use an 8% vacancy rate. If you're dealing with a bank, the banks will typically let you get away with a 5% vacancy rate when you're calculating this stuff. The reason why I use 8% is because that just assumes that basically every unit in the building is vacant for 1 month, right? Because 1 divided by 12, 1 month divided by 12 is 8.25 or something like close to that, right? So I just round that to 8. So that's why I use 8%, but a bank will let you get away with 5%. Okay. All right. Next one we're going to talk about is the debt coverage ratio, abbreviated as DCR. Debt coverage ratio is something that the banks like to look at and something that they will require as part of your term sheet when you go invest in a property. But the debt coverage ratio, that's a benchmark that, again, the mortgage companies or the banks will use to measure an income producing property's ability to cover the monthly mortgage payment. So obviously the higher the debt coverage ratio, the better. Because higher debt coverage ratio means lower risk, right? You're able to cover more of the mortgage, right? So if for some reason you have some tenants that are not paying rent, or you have some vacancies, then you're still covered if you have a higher debt coverage ratio. So the way you calculate that is you divide the net operating income, or the NOI. Remember, the net operating income is annual operating income minus annual operating expenses minus vacancy. That's the net operating income. Okay. So the debt coverage ratio is divide the net operating income by a property's annual debt service. So in the residential world, the debt service is the mortgage, right? The debt service, that's the term in the residential world. That's just the annual mortgage amount. So you divide the net operating income by the annual debt service. Okay. So the annual debt service equals the annual total of all interest and principal paid for all the loans on the property. So that's the total of all your mortgage payments, interest and principal for all the property over the course of the year. So a debt coverage ratio of less than 1 indicates there's not enough cash flow generated by the income producing property to cover the mortgage payments, right? So if we say there's a debt coverage ratio of 0.8, that means there's negative cash flow, right? Because there's only enough income to pay for 80% of the annual mortgage payments, right? And obviously a bank wouldn't like that, because then you have negative cash flow, you're losing money every month. But a debt coverage ratio of 1.2, that indicates positive cash flow. That means there's 1.2 times, or 120% as much cash income coming in as there is debt, right? 1.2 times as much annual income as the annual debt service on the property. So here's the example. The debt coverage ratio, here's the formula. The debt coverage ratio equals the net operating income divided by the annual debt service. So you remember those formulas. So if we had a net operating income of $36,000 a year, and we had a debt service or a total mortgage amount of $30,000 a year, we take the 36,000 and we divide it by the 30,000, and that gives us 1.2, a 1.2 debt coverage ratio. 1.2 is not great. Banks typically like to see at least 1.3, at least. Some banks like to see 1.4 because they want to know that they're covered if for whatever reason you have vacancies or tenants don't pay, that they're still going to get paid, that it's less risk for the banks. Okay, so that's typically, if you get a term sheet, you're going to see that. That's not the main factor that you're going to probably use when you're analyzing these properties, but it's just something to be aware of and you want to calculate when you do this. Okay. So there's two main ways that investors will analyze multifamily properties. There's plenty of different ways, but I would say there's two main ways. You have cash on cash return and you have the cap rate analysis. So they're the two ones that we're going to focus on, the cash on cash return and the cap rate analysis. So let's talk about cash on cash return first. All right. So let me just take a little drink. All right. So cash on cash return is the ratio of annual before tax cash flow to the total amount of cash invested. And we express that as a percentage. So it's the annual before tax cash flow, or the annual cash flow before we pay real estate taxes or income taxes, the annual before tax cash flow to the total amount of cash invested. So how before tax cash flow is derived is we take the net operating income. Remember, you have to remember the net operating income formula because there's so many formulas that use net operating income. So remember, net operating income equals the annual operating income minus annual operating expenses minus the debt minus the vacancy. Net annual operating income minus annual expenses minus vacancy. Okay, so you calculate the before tax cash flow by taking the net operating income and subtracting the debt service. In this example, you're subtracting the debt service. So assume your before tax cash flow was $36,000 and the cash that we invested in the property is $150,000. Now the cash on cash return would be equal to 24% because we take the take the 36,000, we divide it by the 150,000. So the 150,000 of cash that we invested, that 150,000 can be 150,000 on a $150,000 property, meaning we bought the property in cash, or that 150,000 could represent 20% of a property that is $3 million, right? If I did that math correctly. Because if you have to put down, let's just say 20%, I mean, typically a bank wants to see 25 to 30%. So let's just say 30%, right? If that 150,000 would represent 30% of a $4.5 million property, right? Let's see if I did that math right. No, I didn't do that math right. I was off by a zero. 150,000 would be $450,000 property, right? Yes. Or 500,000. 150,000 divided by. Okay. So anyway, the 150,000, whatever the math works out to be, 150,000 would represent your down payment on the property, whether that's 20 or 25 or 30%. Okay. So that the key is how much cash you put in. So if your cash flow is 36,000 and it's $150,000 of cash you put in, your cash on cash return is equal to 24%. So 24% on cash return is not bad, right? Because if you think about cash on cash return as it relates to other vehicles, right? Some other vehicles meaning other investment vehicles that you might put your money into is, number one, if you had $150,000 and you put that $150,000 in the bank, you would make, I don't know, a fraction of a percent, a small fraction of 1%, right? And that would be your cash on cash return if that money was in the bank. If you invested in a bond, right? The bond could yield a couple percent, 3, 4, 5%, whatever the bond rates are right now, that would be that. Or you can invest your money in the stock market. You have 150,000, you invested in the stock market. Historically, the stock market returns on average 7 to 9% every year, historically, say 8%. So you get 8% if you put that money in the stock market historically. Or you can take that 150,000 and put it into an investment property And in this example, your cash on cash return is 24%. So way better return on your money if you put this property into an investment property. So real estate historically has always been a better investment than the stock market, bonds, or the bank historically. I mean, certainly there's years where that's not true and the stock market does better, but historically speaking, the real estate is a better investment. Okay. So when we analyze these properties, there's one main way that I look at these properties, and I think this is the most equalizing way to look at all properties, and that's the cap rate analysis. So cap rate stands for capitalization rate, right? Cap rate or capitalization rate, it's a ratio used to estimate the value of income producing properties expressed as a percentage. Okay, cap rate 6%, 7%, 8%, 9%, right? Or you'd say 7 cap, 8 cap, 9 cap. That's the slang way of saying it. If you want to talk the language of investors, that's how you would talk. I'm looking for an 8 cap property, right? That means I'm looking for something with an 8% capitalization rate or 8% cap rate. So the way we calculate cap rate is we take the net operating income, and by now you should all know what net operating income is. We take the net operating income and we divide that by the sales price. So, and we're going to go through some examples, but cap rate, it's more reliable than gross rent multiplier. So we didn't go through gross rent multiplier today, but it's more reliable than gross rent multiplier because unlike gross rent multiplier, cap rate analysis uses income, it uses expenses, and it uses vacancy. Gross rent multiplier does not use expenses or vacancy, so it's not a good equalizer in properties. Cap rates vary from one neighborhood to the other, so that's an important thing to know. So I know we have people all over the country on this call, and I know a lot of you sell stuff in all parts of your neighborhoods, and it's important to know what the cap rates are from one neighborhood to the other, because just because you're in one city, so using Philadelphia as an example, just because you're investing in Philadelphia doesn't mean you're going to get the same cap rates from one neighborhood to the other. So in a neighborhood like Rittenhouse Square, which is a more established neighborhood, the cap rates are going to be lower because it's typically a safer investment. Safer meaning, you have a better chance of your tenants paying their rent on time. It's, a safer neighborhood if you have to go collect rent. Whereas if you go into a neighborhood that is not like Rittenhouse Square, let's just say like North Philly, for example, the cap rates are higher in that area because it's considered a riskier investment. Potentially you have more vacancy, potentially you have tenants that are not paying rent. So you look for a higher cap rate in those neighborhoods because it's a riskier investment. So when you go into neighborhoods that have higher cap rates because they're riskier, you're looking to make more of your money on the front end, meaning in terms of monthly cash flow, versus in a neighborhood like Rittenhouse Square, which is more established, you might be willing to take a lower cap rate for a more stable investment, knowing that property value is probably going to remain stable or go up over time. So you're making more of your money on the back end, right? But cap rates vary from one neighborhood to the other, and you have to study the comps in your neighborhood to understand what prices and what cap rates properties are trading at in those neighborhoods. Okay. So higher cap rates mean more net monthly cash flow. So the higher the cap rate, the more monthly cash flow you're going to have. Cap rate, when you're doing that analysis, it assumes that it's a cash deal. So it does not factor in debt service, but it does not really matter when you're doing this analysis, because if we're just looking at the cap rate, we can still look at if it's over a certain percentage, it's going to cover the debt anyway, right? If your mortgage is 4% and you have over a 4 cap, it's going to cover it. So we don't need to include debt service in this calculation. So here's an example. Let's assume we have a net operating income of $36,000 a year, and the asking price on the property is $400,000. So a lot of times, especially in Philadelphia, people don't know how to price properties the proper way. And a lot of times buyers don't know how to make offers on multifamily properties because they just don't understand it, right? So it's up to you as real estate agents and you as investors to educate yourself and educate your clients on how to look at properties. So assume that the net operating income is $36,000, the asking price is $400,000. So to figure out the cap rate, we would take $36,000, which is the net operating income, and divide that by the asking price of $400,000, and that gives us a 9% cap rate, or a 9 cap. Now, typically in most situations, a 9 cap is pretty good, right? It's very good. And in good neighborhoods, it's great. But in some neighborhoods, 9 is not great. You can get 10, 11, 12 in certain neighborhoods. So it's important to understand that just because you're seeing a 9% cap rate doesn't mean that that's a good price in a specific neighborhood. Okay. So another example is, what if you don't know what if you don't know the proper price to ask for, or to offer for the property, but you know the cap rate that you're looking to pay, or the cap rate that your investor is looking to pay? The way to figure out what the proper price is if we know the net operating income, right? If we know what the annual operating income is, and we know what the annual expenses are, then we can put together the net operating income formula, and we can come up with understanding that the net operating income is $36,000. And we know that cap rates in this area are 8%, right? Or plug in whatever percent you want. Or we know that I like to buy stuff in this area 8%. So we take the net operating income of 36,000, we divide it by 8%, or 0.08. And that tells us that we can pay up to $450,000 for this property. So that means that if the property is being advertised for $500,000, that means that if you're a disciplined investor, that's too much, that we can't pay $500,000 for this property, but we can pay $450,000, or we can pay below $450,000. So anything under $450,000 would work for us in this situation, but anything over $450,000 probably wouldn't work if we're strict about sticking to our 8 cap formula. Okay. So, if anybody has any questions on that, you can put it in the chat box. But I'll keep going. If not, we can come back to that. So cap rate's a very good way to look at properties. It's a very good formula to use to really understand what you're willing to buy in an area, and cash on cash return as well. Okay. So how do you finance these deals? So now you understand how to invest. Now you found properties that you like. How do you understand how to put the money together? And before I do that, I see a question in the chat box asking, do we use cap rate analysis for a duplex? The answer is yes. You use cap rate for analyzing a duplex. You have a lender telling them not to use that approach. I don't know why they would say that, but yes, you should use cap rate analysis. I don't know what other way that the lender would want you to use besides something like that. But anyway, like I said, everybody has a different way to look at things. This is the way that I look at things. So this is just one way. Okay. So back to financing. So there's 2 main ways that investors finance an investment. Either you can buy it in cash, right? That means you have enough money in the bank to pay for the full purchase price of the property and closing costs without a bank involved. Or 2, you can get a mortgage on the property. Okay. So with the mortgage on a property, depending on what it is, if you are buying an owner occupied investment property, right? There are programs out there through FHA or other programs that you can buy for as low as 3.5% down if it's owner occupied financing. If it's not owner occupied financing, typically, now this is not in all cases, but typically for multifamily properties or mixed use properties, the bank is going to want you to put down, I say 20 to 30%, but typically it's 25 to 30%, typically 25 to 30%. And these days, like over the last 6 to 8 months, I've seen more banks wanting at least 30% and fewer banks going below 30%. Unless you have an established relationship with the bank already, and they already know you and they already have business with you. They want to see more of your money into it because it's less risky for a bank. Okay. We're not going to really dive into the state of the market today. But what I will say is that there's no bad time for a good investment. In good markets and in bad markets, there's always going to be good investments. So being an investor is about being a good shopper. I know some of you on here are good shoppers, but being a good investor is about being a good shopper. And what that means is you always have to be looking for properties. You always have to be shopping for properties, but you don't always have to be buying properties, right? That's the difference. There's shopping and there's buying. If you're not shopping enough, and then all of a sudden you decide you want to buy a property, then you're only going to have a very limited amount of properties to be looking at to pick from. So, you're going to maybe be more desperate to pick from the small pool that you have, and the marginal deals are going to look like great deals because they're the best of the bunch that you're looking at. Whereas if you're always shopping, always looking, even if you're not looking to buy, when a good deal comes along, you have a lot more to compare to. You'll know what happened. You'll know when it's a good deal, and you know when you can buy it. For me, a lot of the deals that I've bought have come at times when I didn't want to be buying a property, where I already had too much on my plate, and I wasn't looking to buy a property, but the good deals came along, and that's how it is. The good deals come along when you least expect it, and a lot of times when you don't want them to come along, and you have to find a way to buy them, whether you use your money, whether you partner up with somebody that has money. The good deals, when they come, you have to be ready to move on them. You can't drag your feet on them, because the good deals come and go, and the best ones go very quickly. All right. So there's two main ways that investors will manage their investments, right? You can self-manage the property. So that means that you are going to manage everything yourself, or you can hire a property management company. So with property management companies, they will handle all the rent collection. They'll handle annual leasing of the properties. They'll handle renewals. They'll handle all the maintenance requests and the calls from your tenants that come in. Sometimes those calls come in at 3 a.m. They handle annual rental certifications and all the certifications. I have a property management company for all of my properties. I manage it myself, but I have a property management company. Philly Living Management Group is our property management company, and we manage our own properties, but we have a company that does it. I remember years ago when I bought my first investment property, I got a call at 10 or 11 o'clock at night, right when I was sleeping or about to go to sleep. And it was from one of my tenants, and they said, PGW, the gas company, is at the property now. They smell gas, and they need you to come over here right now, or they're breaking down the door. And it was 10 or 11 o'clock at night, and I was in my bed, and I'm like, oh, this sucks. And the next morning I woke up, and then my first call was to hire a property management company. And it's the best thing I ever did. And it makes your investments worthwhile and fun, because, having to take all those phone calls and having to, be available at all times of the night. Our property management company takes calls at 2 and 3 in the morning sometimes. It just happens. So unless you want to be doing that, I would recommend hiring a property management company. So if you did hire a property management company, you would want to build that into your expenses and into your analysis when you're analyzing these properties. Okay, so that is it for the presentation of Investing 101. Hopefully you guys enjoyed the presentation. I told you it was short today, and I knew we were going to get out of here within an hour. I want to open this part up for questions. So if you have questions, you can feel free to unmute yourself, and we can go over those questions, because I'm sure you'll have some. We went over a lot of information here, and this is basic, but it's not really that basic, but it is basic, and it's good to get you guys started. So I'm just going to look through some of the chat here to see what we have. I'm just reading through Min's explaining how he analyzes some things, of course. I have a question here. Can a cap rate be used for a package of 2 condo units, or is there a better method? Yeah, you can use it. You can use it for 2 condo units. You would just plug those units in as 2 units and put in all the total up the expenses, and run the analysis the same way. Do I use IRR to analyze deals? I have used IRR, because IRR is investment rate of return. And that usually, when you calculate that looks at your rate of return over a period of time. And yes, I have looked at that. And when you're dealing with institutional investors who are more knowledgeable, they look at IRR. They want to see the IRR and want that to be a certain percentage. I don't look at it, because I try to keep my stuff simple, and the more complicated this stuff is, the harder it is for everybody to understand and explain. So that's why I don't look at it that way. But a lot of people will look at it that way. We didn't go over that today, because this is a basic 101 class, but we can certainly go through that in the next level class. Somebody asked, when's 202 going to happen? We do have a 202 class. I don't think that's what it's called, but we have a more advanced class as well. So we'll be doing that as well. My email, I guess people were looking for my email. Sure. Happy to put that in the chat. It's noah@phillyliving.com. Okay. I just put that in the chat. Another question came in. Do I only buy value add properties? These 2 condos are in A+ locations, but they don't need much work. So here's my investment strategy. My investment strategy is fairly simple. It's 3 parts. Number 1, I have a job, right? My job is selling real estate, running the real estate brokerages, all of my sales team. Like those are what I would consider my jobs, right? That's what I come to work every day to do. Then the money that I make off of that, I take that money and I put it into development. So I build homes and I sell those homes, and that's where you make the big chunks of money. And then I take that money and I roll that into the long-term hold stuff. That's the wealth building stuff, which is the investment properties, right? That's the cash flow. That's the passive income stuff that we talked about in the beginning. That's the make money while you sleep. Because every month on the first of the month, which is when my tenants pay me rent, on the first of the month, I get an influx of cash that comes in from all my tenants that pay me rent on the first of the month. And I'm not saying you don't have to do anything for that, but it's not a ton of work to do that, especially if you have a management company. So that's the ultimate goal for me, is to build up my passive income, my wealth, so that my passive income covers my personal expenses, so that when my kids are in college, I have freedom, I have financial freedom, and I have freedom to do what I want when I want to do it. And all my expenses are covered, because I know there's a lot of real estate agents on this call. If I asked you, and you don't have to answer, but you can answer yourself. If I asked you, if you stop selling real estate tomorrow, or if something happened to you and you couldn't sell real estate tomorrow, or whatever your job is, how much money would you have coming in passive income? And the second part of that question is it enough to cover all of your expenses? And for a lot of you on this call, the answer is no, it's not enough to cover your expenses. And for a lot of you on this call, it's zero. You don't have any passive income. And that's okay, right? Because you're on this call to give you a little kick in the butt, to get you motivated and give you some knowledge to be able to go out and take the first step and do it. But the key is you have to do it. It's not too late. If you're 20 something years old, great, you got plenty of time. If you're 30 something years old, great, you have plenty of time. If you're 40 something years old, great, you have plenty of time. There's really it's not too late. And if you're in your 50s, you still have plenty of time, right? Because it doesn't take a lifetime to build this up, right? You can, within 1 year, you can have some money coming in, right? Maybe it's enough to cover your mortgage payment, right? Maybe the next year it's enough to cover your mortgage and your car payment, and maybe some other stuff. And then, every year you're chipping away at this goal. You're saving up enough money to have enough money to put as your down payment, so you can keep chipping away at your passive income goal. So every year you're able to have more and more passive income, and then you can do more of the things that you want when you want to do them. You're not married to your job, right? You're not always working for money. Your money is working for you at this point. So that's my strategy of how I do it. So I think that was the answer to the question of, do I buy value add properties? For me personally, yes, I only buy value add properties right now. Most of the stuff that I buy is stuff that I can build new construction on. So either it's a vacant piece of land where I can build a new construction, like multifamily property in this example, or mixed use, or it's a building that I'll tear down and build multifamily. I have done a couple rehabs over the years. One of my early ones was a 3-unit rehab, which I've recently sold. I don't sell too many things, but I recently sold that one. Did a 1031 exchange on that. Took the profits of the 1031 exchange and the money I had put down on the property, and used all that to buy a property that was more than double the price without having to put any more money into the deal. But I've done a 19-unit building in University City. It was like a 20,000 square foot building. That was a gut rehab, but I don't do a lot of them. I just find it easier to do new construction for me, because I don't have to worry about other people's problems. But I will say, when you do rehabs, you find some cool stuff in the walls. I found a newspaper in the wall of this building I did. It was from 1937. It was still fully intact, and it was very, very cool. And I also found an old ladder in the wall. Back in the day, the old ladders were basically ropes that they threw out of the second or third floor windows. And if there were a case of a fire, they would climb down these ropes. It's pretty interesting. So you don't find cool stuff when you do new construction. All right. So I have another question here from Min. Do I have investment strategy template worksheets? Yes. I have a cap rate analysis sheet that I have. If you email me, I will send it to you. And just ask for the cap rate analysis spreadsheet. It's a very good sheet. I spent a lot of time putting it together. It's an Excel sheet, but it's very intuitive. It's dynamic. It will do everything you need to do, but I want you to make sure that you know how to use it. So you need to be able to do this math on a napkin, on a piece of paper, so you can explain it. And then you use the spreadsheet to like do it quickly, but you still need to be able to explain it. And do I also include closing costs in addition to down payment? Yes, I do. That would be the total cost would include the down payment as well. Okay. And yes, we recorded this Zoom. For those of you that are part of Keller Williams Philly or Keller Williams Mainline, we will be posting this recording in the private Facebook group. So you'll have it. For those of you that are not part of those brokerages, you can email me and I can send you a copy of that as well. All right, next question. What percentage of rental income do you set aside for all those maintenance items that always pop up throughout the year from each rental property? I don't necessarily use a percentage. I use a dollar amount because remember, most of the stuff that I do is new construction. So I don't have as much maintenance on my properties. Maybe in the first 6 months I do because they're new construction, but after that, I don't have a ton of maintenance stuff that comes up. So if it's a smaller building, I might put $2,500, medium size, I might put $5,000. That's about all that I do, but I put money in for repairs and I put money in for maintenance and I put equal amounts of both. I'm a little more conservative on my properties when I'm like analyzing them for myself because inevitably something always comes up that you didn't anticipate. So I'm a little more conservative. But when you're presenting to the bank, maybe you're a little less conservative because you want the bank to finance the deal. So, you sort of have to know the audience that you're playing with. But if you're looking at this internally for yourself, you want to be more conservative. Next question. Are there any resources where we could find a typical cap rate by neighborhood? For example, Rittenhouse or Brewery Town. It's a good question. And every time I teach this class, I always get that question. And I wish there were a resource that had that. Unfortunately, there's not one that I'm aware of, at least, that just sort of shows you what it is in each neighborhood. I probably could put one together for Philadelphia because I know the area well enough. But I would say as a general rule of thumb, if we're talking about Philadelphia, because I think most people on this call are from Philly, Rittenhouse Square, stuff is trading at like 5 and 6 cap, 5 or 6 cap because they're good areas. But most other like decent areas in the city, if you can get stuff for a 7 cap, that's pretty good. If you can get stuff for an 8 cap in most of the decent areas of Philadelphia, that's great because there's not a lot of that exists. And the reason why it doesn't exist is because people that have those types of properties are not really selling them. Why would you sell them if you have such like a good cash flow coming in every month? That's what a lot of these people that buy these types of properties want, this cash flow coming in. They don't want to sell them unless they needed the money for something else, for a 1031 exchange or to do something bigger or whatever. Right. So you're not seeing these investors sell stuff at an 8 cap. They want to buy it at an 8 cap. But you don't see them selling it at an 8 cap. So the only, like a lot of neighborhoods, in order to get that, you have to add value to it. It's maybe it's a property that needs some work that by adding value, if you don't know what that term means, it means that you buy something that you need to put some money into. And by putting money into the property, it raises the rent, it raises the value, raises the rent of the property. So in turn, it raises the value of the property, right? So if you buy a property, let's say it's an older building where the rents are, $1,200 a month, and you add X amount of dollars into the property, and now your rents are $1,600 a month, you've added value. But there's a formula for that too, right? Because you don't want to spend, $200,000 just to raise rents by $50, right? That doesn't make sense. So you have to figure out, if by putting this money into the property, is it going to raise rents enough to actually add value to the property? So that's what value add means. Yeah, word of mouth from other brokers, or really just figuring out all the things that have sold in the last 12 months and figuring out what cap rate those traded at, right? That's like a way to figure it out. But I don't even pay much attention to that, to be honest with you. I have my own investment strategy. I'm not really like a risky investor. My investments are typically in like the more solid areas. I'm not typically buying in like major up and coming areas where I have to wait many years to like have good tenants, or, you know, or get good rents. I'm typically buying in like the better areas of Philadelphia, and I pay more money for my properties to do that, of course. And I'm willing to do that because I get higher rents from my properties as well. But I'm okay with that. That's my strategy. And I know when I buy something, I know the areas I'm buying in. I know the cap rate that I'm looking for. So I know for me if it's a good deal or not. It's much easier for me to analyze properties quickly when I'm going into an area that I already know, with a formula that I already know, with the rents that I already know. You know, I know what I can get for a 1 bedroom, a 2 bedroom, and a 3 bedroom in the area because I do other stuff in the area. So if you can do that, that's better, because if you go into an area you don't know, you're guessing on the rents to some degree. I mean, you're going to run comps, of course, but to some degree you're guessing, because not every rental comp is put in the area where you look, right? Because some of it goes through Zillow, realtor.com, it trades privately. Like, it's just not, you don't have a full resource like we do with residential MLSs. So it's good to stay in the area that you know. All right. And would I suggest buying each rental property under a separate LLC or within one LLC? That's a very good question. The advice that I've been given is buy them under separate LLCs to protect yourself, and to not tie all your properties together. In the past, I've bought a lot of properties under the same LLC just because it was easier for me to do that. The problem is if you have problem with one property, or if one property gets a lawsuit or something, it attaches to all your other properties, which would affect your ability to get loans on those properties, or refinance, and it just affects those. So it's better to now I have a different LLC for each property. It just protects you a little bit more. It shields you a little bit, and it doesn't tie your properties together. Another example is I have a bunch of properties under one LLC, and I had I don't know, some money that was owed to the city of Philadelphia for, I don't know, it was like a trash violation or something. It was like a $200 trash violation that I didn't even know about. But I found out about it when I went to go get a tax abatement for a property, and they said, we can't give you your tax abatement because you have money owed to the city of Philadelphia. And when I, asked what it was for like a $200 violation on another property. And it took me months to get that cleared up. Even though I paid it right away, it took the city of Philadelphia months to get that cleared up for me to be able to get my tax abatement. So that's another downside to tying properties together as well. These are great questions, guys. Really, really good questions. If anybody has any more last minute questions, you can put it in the chat box. Otherwise, thank you for being on the call today. I want to try to keep my promise of keeping this to about an hour. And thanks for being here today. I really hope you guys learned a lot. This is not something that you learn and master the first time you hear it. You have to watch this video over and over again. You have to practice it. You have to take some sample properties and do some analysis on them yourself so you can really understand how to do this. And just keep practicing until you master it, and go out and teach it, and go and talk to your clients about it until you become the expert. But take that first step, start becoming an investor, start building that wealth, start building that passive income. And so you don't have to wait till 65 to retire. Thanks, guys. Have a good day.
Thank you so much. Thank you. Appreciate it.
Thanks.